Welcome to Operating with Positive Impact, a brand new series of podcasts brought to you by PwC. My name is Anthony Nev, and throughout this series, I'll be your personal guide in shaping your organization into a sustainable business. Together, we will deep dive into the world of sustainability and its impact on a business world. During our last episode about the strategic angle of ESG, we discovered that looking into non-financial information could significantly impact a company's strategic direction. The next logical question we will tackle in this episode is how ESG can influence a deal's journey. To guide us, we are welcoming Véronique Gillis and Opsomer, both partners in the PwC Deals team, and also Florian Jacques, a senior manager in sustainability. Let's listen to their perspective on sustainability in deals.
Hello, I'm Opsomer of our Deals platform in Belgium, responsible, amongst other matters, for ESG in deals. I'm happy to be joined by Véronique Gillis and Florian Jacques for today's podcast on the impact of ESG on deals. Véronique is our deals leader in Belgium, with obviously tons of experience in terms of advising clients on M&A transaction. Florian is our ESG expert and advises clients on a broad range of sustainability matters. Amongst others, he conducts ESG due diligences and also helps our client in integrating their ESG strategy in their investment strategy, basically. So, Véronique, to start off, what is your intake on the impact of ESG on your day-to-day deals work?
Well, we see ESG gaining importance over the years, from pure compliance and risk identification towards more focus on value creation opportunities. And I see this with my clients. ESG is clearly gaining importance in the deal cycle. When we are working buy side or sell side and we are doing due diligence, the clients ask more and more for ESG due diligence next to the more traditional finance, tax, legal, HR or IT. And I think it will soon probably be given the same attention as those areas. And also, some recent surveys have shown that emphasis on ESG has increased significantly. Peter, I have a question for you. Which pitfalls are there that can have an impact on deals?
Well, Véronique, it will not be a surprise that we have actually a framework for that. It was designed on the initiative of our global ESG leader in deals from Canada. And we talk about the 6 orange flags. We don't call it red flags because there's still an opportunity in turning that into value. So it's a bit between a risk and an opportunity. But let's go through the 6 flags we have. We have, as first one, unethical marketing. And basically, that's nothing new. I mean, marketing can be unethical in different dimensions. What is new is that also the ESG dimension plays a very important role. If you're not walking the talk, if you're not doing what you're saying, you can get into trouble. The second one is reputational risk. We have all heard about greenwashing, about not complying with frameworks, about committing fraud, even in reporting on ESG matters. And of course, in association with an acquisition, if this comes out, it has a huge impact on the value of your transaction. Then, as a third one, we have the high-risk supply chain. This goes a bit without saying. You have supply chains that will be impacted either by climate or by social matters or by the fact that there's too much CO2 emission. And of course, measuring then how resilient your supply chain is and making sure you have alternatives for your current business is hugely important. The next one, the fourth, is a bit less expected. And then we talk about disengaged employees. What we see is that people like to work for firms, like to stay with firms when they really feel that the values of the firm match their own value, that the firm, the activity, finds those things as very important, which they find important themselves. And of course, a disengaged workforce can have a huge impact because the people factor in deals, the know-how, the intellectual property that is lodged with your people is enormous. The fifth one is transformational deals that don't deliver. ESG has resulted in the need for creating new balances. In the past, you could have a transformational deal that is just about cost saving, synergies. But now, if you go for cost savings, you also have to take into account the impact it has on the environment, and the impact that might come far ahead on your organization. So it is an additional factor, a very important additional factor to take into account when doing just transition, we call that. And the last one is inadequate non-financial disclosures. The regulations in that respect is going up, and the stringent framework is coming closer and closer to financial reporting, and hence that impact will be huge. And what we often see in less advanced companies in terms of ESG is that they sometimes have a good idea about what the consequences are of their activities, but they measure it in a very approximate way, or they don't really have sustaining evidence for what they're proclaiming, and then of course you're into trouble.
Okay, thank you.
Maybe if I can react on the last one, the inadequate non-financial disclosure, we see also that you were talking about the risk and opportunity side of those flags. That's an important one, because the more we get data, the more the financial investor are able to integrate that into the model as well. So the importance of that non-financial disclosure is gaining in importance over time as well.
Okay, thank you, Florian. And as you are talking about risk and opportunities, when you are looking at a target, how do you identify the main ESG risk and opportunities for that target?
Yeah, so obviously you cannot look at everything on every target. So indeed we prioritize. To be able to prioritize, we look at what we call materiality. We look at what are the most critical / material ESG related topic for that company. To be able to do that, we focus on different geographies, on location, the business model. What is material for a pharma company is very different than what is for a chemical company. So we analyze those factors to be able to focus the due diligence report on the ones that are really material, having an impact on potentially the value of the company, or that are destroying the value of the company. And then based on those material topic, we also do benchmarking to look how mature are they, looking at peers, are they performing better, maybe a bit lagging behind, what are KPIs they're not yet tracking, and those are also elements that have a value for the investor to be able to see what is the maturity, but also to see what is the potential for them to grow over time, or to evolve over time.
Okay, thank you. Peter, when companies are preparing themselves for a transaction, how can they prepare themselves, especially on ESG aspects?
Yeah, it is clear that traditionally when a company is about to go for a transaction, normally a couple of years, sometimes ahead of the deal, they will prepare their financials. They will make sure they invest smartly, not too much, but just enough, basically. They will prepare their financials for being ready for a deal. The same goes, in fact, for ESG. Because if you fail to prepare, if you don't determine what next steps you will take and what the impact of that will be on your short and long-term business plan, it means that the potential acquirer will do that. It means if you don't give guidance where you stand, they will do it for themselves, and then you're out of control. So there is a couple of steps that are really, truly important, and those are the basics in terms of preparing for a deal. You should first of all have a strategy. Even if it's not yet fully implemented, that's not so important, but at least you give a clear image to your potential investors what the important topics are and where you have to go. The second step is then making a roadmap as to how to get there. That is important to make the link to the business plan, of course, both in terms of effort, cost, but also in terms of upside. When you don't prepare that, the upside is often forgotten. For instance, if you succeed in having a much greener product, you will get access to new markets. Access to new markets, often at higher margins, are clearly a value-creating activity. And then you also have to determine your objectives and KPIs that underpin them, and make sure that you can measure, or you know how to measure your KPIs going forward. Giving there about the most material aspects, already indications of the KPIs, is crucially important, and hence the importance of Florian's bit on materiality. Once you have the KPIs, you start measuring and tracking them. And then, of course, if you have all of that together, you have to make a business plan that incorporates that, because you want to make sure that it's correctly translated in your valuation you get. And that is then basically the end step. And you prepare the historical data and you prepare everything in a data room. And then the due diligence people of the investors can go ahead and check what they need to check.
Yeah, indeed. Well, when we talk about M&A or deals, we often think of two important channels, being the private equities and the corporate. Is ESG in deals as important for both of them? What are your views on that, Florian?
Yeah, very good question indeed. We see that the role of private equities is evolving as to ESG in general, and we see that they're also helping and supporting more than in other fields the portfolio companies they have. And we've seen over a couple of surveys that PwC has sent out over the years that we see a trend that value creation is being increasingly important if we look at global private equities around the world. In Belgium, we see that actually corporate values is the ones that it's just at the same level or even a bit higher. And that's also because in Belgium, we have a lot of family-owned businesses as well as family-owned private equity. And that's also why ESG is such at the forefront for those private equity when they acquire or when they do an exit. But if we look at the corporate side, for them, it's also important for two reasons. The first one, right, they get loans potentially from financial institutions, they get obligation credit facilities, and the banks are increasingly looking at what is the interest rates that can be adapted based on ESG criteria. The other side is when corporate do acquisition, they also want to understand what is the impact on my performance. Is that a polluting company? Is that a company that is already far advanced in terms of greenhouse gas reduction? How is that going to impact my own ambitions? So there's also a reflection on that side. And as a conclusion, we see just in general that those two actors, for different reasons maybe, are actually acting upon ESG and integrating ESG in their day-to-day actions.
It's basically a bit of a peculiar area because, for instance, for the PEs, you don't have to forget that behind those funds, there's also other funds, pension funds, that are basically totally funded by employees. So you can imagine that if you as a fund don't do what is expected or you don't try to walk the bright line, that at a certain point in time, those funds might get out, basically. And of course, that will have a very significant impact on your activity. So yeah, it's really growing.
Okay, thank you. And when a deal is done or completed, I suppose that it does not stop there. So can you please explain, Peter, what is important after the acquisition?
Yeah, so basically, and I often compare to what used to be the case in the past, you typically, while doing your due diligence, you're taking stock of where the company stands, what the issues are, and then when you successfully completed the transaction, you will get to work. And getting to work is basically for operations, but as good for ESG and in fact integrated, you start establishing your 100-day plan. And beyond that, you have your strategy of how you're going to operate or integrate the business. And that's basically a matter of following up with focus, with priority, the different steps you need to take. And also to decide on what pace you want to go. And that's for a normal integration like that, but also for an ESG integration. If you go too fast, you can destroy value because you can destroy business. If you don't go fast enough, all of a sudden, everything can stop, of course. So that's a very important one, to really take into account the ESG angle in the integration or the further operation you want to do with the acquired company. Now, even more important, and that's mainly driven also by the non-financial KPIs that need to be reported, is that you need to align. Because in the end, you need to make sure that you can report at consolidation level, group together, basically consolidated non-financial KPIs. With a financial framework, that's kind of easy, even if the different activities are fairly different from each other. You still have revenues and cost of goods sold and EBITDA. And I mean, there is a very tight framework for that. But if you have non-financial KPIs, you have to define part of that content yourself. And also the materiality and the KPIs might be different. But still, you have to make sure that you align in such a way that you come with a coherent whole, which is particularly complicated if, for instance, you would buy companies that are not so well performing with ESG to basically create value by doing an ESG conversion. And then, of course, it becomes complicated. But aligning there is crucial. And once you have your 100-day plans and you have aligned, of course, you should not lose sight of the fact that you can shift a couple of gears higher. You can go faster than the market just to create additional value in certain areas. What we currently see is that there is a tremendous focus on CO2 emission, partly because of the law, of course, and the potential taxation on imports of CO2 emissions. But we also see that broader. So basically, making sure that the restrictions or the risk of non-compliance become an advantage, in those chosen fields, a lot of companies will shift a gear higher. Yeah.
Maybe just to add on that and to make the link also to private equities, what we see is also that ESG is increasingly being included in some of the term sheets. Right, I said private equity or corporates have different ambitions, right? What is the impact on their own baseline or on their ambitions, right? You were mentioning, climate change, right? There's SBTI, science-based targets. So when you acquire a company, you need to be sure they are going to follow suit and they're going to follow the promises they made. And that's also why some of the private equities or corporates are integrating ESG milestones in the term sheets to be sure that those promises are followed up. So just in terms of aligning, it's also something we see concretely taking up.
Yeah, indeed. Well, it seems we are running out of time, so it's time to wrap up, although we could potentially continue for the rest of the afternoon. But it's perhaps important to repeat just the key takeaways. It's clear that ESG is gaining importance, and they will get, in not so long time, the same attention as the other fields, finance, HR, tax. Very important as well is when evaluating a deal, think of the 6 flags. Make sure that you have covered those areas. And then when we talk about ESG, it is clear that we are talking about more than just compliance. It's also a lever to create value, additional value for your acquisition. One point I would also like to stress is when competing for a deal, ESG is also very important because the framework is different all over the world. So basically, when you have a polluting business, you might easier find buyers in a less ESG sensitive area of the world rather than in Europe, for instance. Voilà. And finally, of course, ESG does not stop at the acquisition. There's work to be done afterwards, and it remains essential to keep the ESG angle there. This is it. If you have any questions or remarks, don't hesitate to reach out to us, and we will definitely address them. Have a nice day.